We recently had a new tax law change. That was back in December of 2017. I don't know when you're watching this video, but one thing for sure is that when it comes to specific parts of tax law, we have changes and then we have the realities of the change. Sometimes things are date sensitive, sometimes it's not. So I can tell you, as we're filming this in 2018, one of the issues that I do get periodically is what you have on the screen, because we're talking about planning for alimony, is that I'll get questions from people that say, it's still deductible, right? And I'll say, yes, it is. I said, yeah, because somebody told me I can't deduct it next year. And it's like, well, that's not exactly true. So let's sort of talk about it. There's a lot of disinformation out there. So part of what I'm going to be doing is I'm going to be talking about the current state of alimony. I'm going to be talking about some of the planning tips that we can do for the balance of 18. But I'm also going to be talking about 19 and 20 years as well, as we begin as tax professionals looking at the documents that we should be looking at as we're preparing tax returns, and some of the things that we should be looking at within those documents. So I want this to be something that's like a very hands-on. Yes, I'm going to be talking about code sections. Yes, I'm going to be talking about law. I'm going to be looking at cases, but also come away with some really good practical things that'll help your practice as we go through these things. But let me just tell you, in general, every so often I'll get what I call the call. It's usually not during tax season. It's usually after tax season, sometimes in the summer, sometimes in the fall. It doesn't matter. But I'm talking with somebody and it's like, hi, Arthur, this is so-and-so. I said, how you doing? She goes, not so good. And you know what's going to come. And usually they start talking to you about how things have been rough and how they have to make some changes in their life, and maybe they're in the process of, maybe they're separated right now, maybe they're heading for divorce. I get a call like this every couple of years, and when you get the call, yes, they want you to be sympathetic in terms of what's going on, but they've already had these discussions with other people and they're getting the sympathy oftentimes of their family members. What they're looking for you is some sort of a guidance in terms of what they should be doing, what things they might have to look to in terms of alimony, child support, those types of factors. So they're looking for facts for the most part. And like I said earlier, they've been talking to other people along the way and they're getting all kinds of different advice. They may or may not have been to an attorney at this point in time. The attorney may have told them to also contact your tax professional to make sure that they and you are in concert with the things that are happening in there. So one of the things that I look for when I hear is like, what are some of the top issues that we should be concerned with as we're going? Well, from wherever you're standing right now, like if we're currently in 2018, there's a clock running. And whenever there's a clock running, mistakes are made. And so what happens is that if people, and I'll be talking about the specifics in a few minutes, but if people have to make decisions in terms of whether or not something is allowed as a deduction or not, and they have to decide by December 31st, 2018, that time period oftentimes gets shortened and shortened and shortened, and then all of a sudden things are put together hastily, and they may not necessarily accomplish the things that they're trying to. And so planning becomes foremost. I'm not asking that you go out and call everybody up and ask them how their marriage is. That's not what I'm suggesting. What I am suggesting is that when you hear things like that, that you begin to take it seriously to say, look, we need to talk about some of these issues from a tax standpoint as we'll be going through it. Because the reality is that if these things aren't squared away by the end of the year, they're going to be your headache during tax season. And during tax season, I don't really have a sympathetic ear. I really don't have the opportunity to start doing things I should have looked at sometimes in the fall. So it's a good thing to say, let's review this beforehand. I'm waiting for one right now for someone who I got actually the call from the mother as opposed to the child, because the child is not that responsive in a lot of different things. And I said, I need to see a copy of the divorce decree. And they go, oh no, it's all set, there's nothing you need to look at. And I go, oh, yes, there is. And so anyhow, those are the things that we want to do. We don't want it to be a tax season problem. We want to deal with it beforehand. It's also important because a lot of times when you are in the throes of divorce, as they call it, there are some negotiations that go on in terms of how much one person is paying the other, how much will be classified as alimony, how much will be classified as child support. And so as we look at a change in the tax law for agreements entered into after December 31st, the non-deductibility of alimony is going to play into some of those negotiations, and it's going to play in different cases, and I'll talk more about that. There's also other things to concern about, what other factors are impacted. I know that, for example, when it comes to taking out IRA contributions and things like that, these factors also come into play. I'm not going to be talking about how this integrates with Social Security. That's well beyond the things that I'm comfortable with, but it does tie into those pieces as well, and that's an area that if you're really good on, you can assist in that as well. And then finally, the other issue that I look at as a very important issue is that for decrees which are already in place, do you want to adopt the new tax laws with them, or do you want to keep them under the existing tax laws? And there are a number of factors that you need to consider, the least of which is the new tax rates that will be in existence for the new year. Sit down and do the math and say, hey, we'd like to maybe renegotiate this and adopt a modification to it to make it under the new tax law. So these are all concerns that I think you can do at any point in time in your practice, but needless to say, our biggest concern going forward is that if there are things that need to be done, let's do them right away before it becomes our tax season issue. A couple of facts about alimony. The more I was researching this area, the more some of these realities kind of hit me, and they aren't necessarily a surprise, but it's like, wow, okay, so now that's the way it is. According to the Census Bureau, 98% of the alimony recipients are women, which means that when we oftentimes talk about when alimony payments are made, and we frequently say the husband's paying the wife, and I say, well, it could be the wife paying the husband. The answer is yes, it could be, but according to the census, that said 98% of the people that receive the alimony payments are actually the women or the females. So that there tends to be that propensity in there, and so as a result, you can obviously find yourself on either side of the fence with regards to it, but when there is alimony, this is helpful. So knowing the rules on each side would be very, very important. I will tell you in almost every case I've gotten calls by the female within that relationship, so we had a chance to talk about how those are treated from a tax standpoint. Other facts that we have that we get from the Internal Revenue Service. There's a mismatch in reporting. When a person pays alimony, that person turns around and deducts it on their tax return. When the person receives the alimony, they recognize it as income and reports it on their tax return. Fact is, according to the IRS statistics, and there's great statistic pages out there if you ever want to look at them, only 49% of those people who actually report money, receive the alimony, actually report that. It's the opposite, is the ones who actually pay alimony, they report it as a deduction, but only 49% of the people that actually receive it report it as income. So there's a big mismatch that exists just from that piece alone. They estimate that the repeal of this alimony provision, which would now have the non-deductibility of those payments on years going forward after 2018, will yield $6.9 billion in new tax revenues, and that's according to the Congressional Budget Office. So this is a significantly high amount of money that they're looking at. Granted, they say it only takes a little small piece of the deficit, but it's a component of it. With regards to that, when they passed the Tax Cuts and Jobs Act of 2017 back in December, and we started seeing all of these things and they were talked about, there was a history within this group of alimony, and it was in the original House version where it was starting with an immediate implementation, which was like right now. And it was like, we need more time to do this planning. And so what happened is that the Senate didn't even consider it as one of their options. But it did show up in the final version between the House and the Senate as it goes to committee. And Code Section 11051 actually has the language where you strike, you repeal, and you do all of that. So if any of you love looking at code sections, like I do, you may want to go to that code section. I'm not going to. That's like, looking at these code sections as part of this act is really like watching, they say, sausage being made. You never want to eat it type of thing, because all it is a series of words: redact, strike, change, delete, things like that, and you can see some of these things basically disappear. The provision finally, when it did get passed, had the alimony change to have what we call a 1-year delay in terms of that provision. There were a number of provisions that didn't take place right away, but they were going to be postponed a year. This was one of them. So this was for years beginning after December 31st, 2018. What it does not do, and this is probably one of the most important things on this slide, is that it does not change existing divorce decree or separate maintenance agreements. So it's not something that's retroactive that all of a sudden makes everything non-deductible, if you will. These are only for new ones that are entered into after December 31st. Okay, so these are just for the new ones. Changes. This changes, just to give you some idea of how earth-shattering this thing. This isn't a new tax law change in terms of this. This is changing 75 years of tax precedent with regards to this specific item. And what I will say is, after reading way too many articles on this, and I'm reading from all kinds of different sources just to get some background data on it, just get used to the word pre-2019, because any divorce decree, separate maintenance agreement that was entered into before December 31st, 2018 is going to be considered a pre-2019 agreement, and anything after that obviously will be 2019 and above. So that's the phrase that I'm seeing all throughout the literature. So it's a buzzword that we have in existence right now. One of the reasons this hit Congress, and it's not the IRS that changed the rules, it was Congress, is that Congress felt alimony was basically a divorce subsidy. And realistically, when you start looking at some of the dollar amounts that were involved in some alimony, there was a question of why should one person get a tax savings and the other person have to pay? But bottom line is that the government was subsidizing your divorce because we're losing tax revenues as a result of these arrangements. And so those were some of the considerations they had. This is one thing that they were looking at. And just to give you an idea, is that if a person is paying alimony, and I know I get some alimonies that are somewhere around $50,000, $60,000 a year. I have some that are in excess of $100,000. So this isn't an unusual amount. But if you got the payor, and I'm just going to use the husband in some of these cases, paying alimony of $100,000 a year, and that person in the 2018 year is in the 37% tax bracket, so they make a decent amount of money. By paying $100,000, they save $37,000 in taxes. Now, at the same time, they're still sending a check out for $100,000 in alimony, but their net cost after their savings is $63,000. On the other hand, the person who receives the alimony is going to recognize that as income. If the female is perhaps with a couple of children or whatever, maybe not be able to work during these child-rearing ages, they may be in a lower tax bracket. And even by getting $100,000 of income, they could have a blended rate after some of their deductions of, say, 20%. There wouldn't be a specific tax rate, but usually some at one rate, some at another. So I use that one as a blended rate. If their tax is going to be $20,000, their net from this transaction is $80,000. So they receive this, they might be making estimated tax payments of maybe $5,000 a quarter or something like that. So their net when this whole thing is over is $80,000. Now from an overall standpoint, I just highlighted those same numbers with green and red just so you can sort of see the difference in there. There's a differential between what one person is saving and what person is paying, and that differential is $17,000. That's what the federal government is losing out on. And so what they basically said is that there's a subsidy that we, the government, is paying, or we, the other taxpayers, are paying, is that we're giving you $17,000 because you're divorced. We don't think this is right. And so that's one of the things that they used as part of that overall argument that they made about repealing the alimony provisions, is that we shouldn't be subsidizing divorce. So that's a cost. Those are some of the dollar figures they talked about. Congress also felt that it was also no longer a rationale for alimony being deductible because many of the states were changing all of their rules. So it was really no longer a federal matter. I was surprised at how many different states had different rules for alimony, but it is driven by the state. So therefore, if you get a divorce in one state versus another state, you could have different rules, different parameters, different dollar amounts, different formulas. And so as a result, the result of a person getting divorced in one state could have a totally different payout than in another state, and then the federal government was still sort of subsidizing those things. So there was enough of a momentous push to get this thing obviously passed. So I'll just leave it at that. I'm not trying to make a political statement, but what I am trying to say is, what is causing these things to happen, and this is what Congress was thinking at that time. And so bottom line is that if we have payments now that are part of starting in the 2019 year after December 31st, is that there's going to be no tax deduction allowed for these new agreements. And so if you pay $100,000, there's no tax deduction for it, and it's going to cost you $100,000. And the person receives it is going to receive it. They don't have to pay taxes on it, so they get to keep the full $100,000. And so if you say, gee, I set up my agreement because I wanted the spouse to receive $80,000 after taxes, then maybe all of a sudden your agreement drops down to $80,000. I write a check for 80, she gets 80, we're done. It's because it's a non-taxable event. If I'm going to modify this transaction because alimony is no longer allowed as a deduction, then maybe what I want to do is come up with that number where we have it on the table. This is what the dollars are worth, because there's no tax implication. We're not playing around with marginal tax rates or things like that. And so as we get to the end of the year, what we're looking at is basically who drives the decision to finalize this by year end. If the alimony is deductible if it entered into by December 31st, 2018, or the alimony is not income if entered into after December 31st, 18, you may have two different parties arguing, I want to get this done versus I want to postpone this. And so as part of the planning goes on, I'm just thinking of the calls that I'm going to get saying, hey, I'm in negotiations right now, I'm not really sure what I should do, but my wife that I'm getting divorced from wants to do this. How does this impact me? We've got to kind of be, to some degree, ready for those types of discussions. So I'll leave it with this. We'll take a quick break,